Right, so welcome to this week's workshop. Thank you very much for your time, your attention, and as always, thank you for taking a moment out of your day. What we're going to talk about this week is targets 3 different ways, and that's what we're going to explore. So at its most basic, we've got pattern targets, we've got projections, and we're going to look at mechanical targets. One of the things that I've been asked in lots of times over the last several weeks, and I've got to admit, it was a question that I was always asking. I remember going back to when I had a job days back in the late 90s. I remember working in Blockbuster Video, and on a sunny Sunday morning, I was going through yet again Jack Schwager on futures, a 1,000-page tomb of a book that just literally explained what the tools, what the indicators were, what the patterns were. And it was something like my 3rd reading of it. Yeah, I know, roll your eyes at me. But I was reading through it, and about halfway through, it occurred to me that at no point does it tell you how to get out of a trade. All of these books, all of these tools, all of these patterns, all of these indicators, the only thing that they really tell you is how to get in the trade. And they very rarely tell you how to get out the trade. So that's the question that I had when I was 19, hand drawing charts. How do we most effectively take profits? That's what we're going to look at today. So we've got patterns. I'm going to go through on the whiteboard here, and then we'll go and take a look at the charts in just a moment. But ultimately, we've got 3 basic ways of finding a pattern. And before I actually enter a trade, what I personally want to know is, where am I going to get out? So all the textbooks, you might be familiar with a pattern. We could be looking at a symmetrical triangle. We could be looking at a descending triangle, or we could be looking at an ascending triangle. You could be looking at head and shoulders. The thing that all of these consolidations, the thing that all of these types of, again, doing the bunny fingers, patterns have, is that they're all consolidation patterns. Price has to meander into them, to these, and they develop a wedge, a triangle, a head and shoulders pattern. And if you start to add them all up, when you try and name all of the patterns, you can have 30 plus patterns that all have different names, different rules, different ways of treating them. And I don't know about you, but I don't want to memorize a different rule set for every pattern. And the thing that a textbook doesn't tell you about the patterns is that they evolve, they mutate, they change. So if you have say a descending triangle, and you think, oh great, it's just, I recognize it, it's a descending triangle, and then it evolves and it mutates and turns into something else, and then you don't know what it's called. So don't worry about the name of the pattern. So that's the first thing. Again, just as a general advice, don't worry about the name of the pattern. When you can spot that price, the only thing that we need to know is price trending up or down, or is it ranging? And it doesn't matter what the name of the pattern is, whether it's triangle, head and shoulders, invert head and shoulders, wolf wave, Gartley pattern, back pattern, Spider-Man pattern. It doesn't matter. All we need to do is go, you know what? Price is in a range, and let's just mark off the boundary high and the boundary low. And let's not worry about what it's called, because the reality is, whether it's a consolidation, whether it's a channel, whether it's whatever the name is, doesn't matter. Just recognize that price is in a consolidation phase or a trending phase. So that's what this is. So pattern is generally a consolidation. A projection will usually use a trending. So we can do 2 things here. So patterns, we're looking at consolidation, and projections, we're typically looking for price trending. So let's look at patterns first. Patterns, consolidations. When you can spot that price is in a consolidation, let's just call it a sideways, a horizontal range, and the more refined, the better it actually is. We should be able to draw a horizontal line on the boundary high. Again, don't worry about lower highs and don't worry about using trend lines. Again, for the reasons that I've mentioned, using converging trend lines, what I've noticed many times is that consolidation patterns evolve and mutate. And what we don't want to do is get in too early on a consolidation pattern on a breakout. But when we are in, we want to know, okay, where's it going? We looked at one earlier on WDC. We're going to look at it again. And it was a bearish breakout. Price broke down out of the range. So the entry is basically on a pullback. So what the textbooks typically say is to place a sell order below, a buy order above, and then basically close your eyes and hope for the best. So the more optimal way of trading any consolidation, so that you don't have to worry about, well, which rule set should I use? Because depending on what you call it, you might use a different rule set. Let's just call it a range. It's in a range, wait for the breakout. So that's what this is, a breakout. Wait for the breakout and then wait for the pullback. Entry is going to be on the pullback. So the first thing that we can do is look for the height of the range. So when it comes to patterns, take the height of the consolidation, and let's just say that's $10. Take the height of the consolidation and project it down from the boundary low or the boundary high. That's it. So there's the first one, nice and simple. The height of the pattern is the first target. And then if you want to, you can start to multiply it. So target 1 would be 1 times 10. Target 2 would be 2 times 10. Target 3, you can start to multiply it out. And all we can do is, if we want 3 targets, we can start to multiply those targets out. If we choose to, we can do that. Me personally, I'm just looking for target 1. I would rather re-enter later, take the smaller profit now, and then I'll look to re-enter again should it provide me an entry opportunity. So let me just pause there. Does that make sense? When it comes to patterns, let's just look at the height of the consolidation and let's deduct that or add that from the breakout. So does that make sense? Pattern targets. Let's go and take a look. Awesome. Thank you for your feedback in the chat box. So we said WDC, great example. Let me zoom. Can everyone see this consolidation? Give me a little yes in the chat box. So we're looking at it at about here, you know, round about there, whatever it is. It's on your radar to watch. So what we've got is, when you can recognize that price is range bound, you're going to need at least 2 touch points. So rather than worry about the name of the pattern, because at first you might start saying, well, yeah, this is a descending triangle and you've got the breakout, yay, happy, happy, and then it doesn't quite get to targets. And this is a good example of why I don't worry about what the name of it is. Oh, and this is that mutation. So here you can see that mutation, it's turned into something else. And then you think, oh, failed breakout, it's a range reversal, it's breaking back in. And oh, it doesn't go to the low of the range. And then it starts to do something else. So don't worry about the name of the pattern. All that's important is that you recognize the phase. The phase is, oh, you know what? Visually, it's in a range. Cool. Mark off the boundary high. There's the boundary low. And in this case, you can pretty much put a straight line ruler on the boundary low. Now that we've got that, I'm going to measure the high and the low. That's all I've done, measure the high and the low. And in this case, I've projected it down to give me this target. Now, what I also do is I have a Fibonacci extension tool. And all I've done is I've customized it to show 50%, 100%, and 80%. So I can measure, you know, because when price is halfway to targets, that's when I'm going to start thinking about some of the trade management that I personally use in my own trading, or 80% or 100% of the way there. So that's what I'm looking for. So we've got a good example here is when price is in a range, take the height of the pattern and then just project it down. So that's what we've got. If the breakout was up, then it project it upwards, and then it's nice and simple. And that's it. That is how we can do pattern targets, pattern projections, again, without worrying about what the name of the pattern is. Let's just do that, because actually we've got a range that we've been trading back and forth. So what I'm going to do is I'm just going to measure the range. So we can see that, can everyone see that we've got the height of the range there? We've got the start point there, the end points there. So there's the height of the range. So what I can do is I can trade the range if it's range bound, but if we've got a breakout, I can project that down. Oh, it's like magic. We can project that down to give us a target. Can everyone see that, what we did there? All we did was we measured the height of the consolidation. We took the breakout points. Again, we only know the breakout points somewhere around here when it's broken, but we know that we've got potential, and that's exactly where this bad boy went to. There's a little bit of follow through, but we've got a pattern projection, a pattern target, and it's based on the range breakouts. So let's go back to my slides. So there's patterns, height of the pattern, added or deducted from the breakout points. So the next one is related, it's projections. So if patterns is a consolidation, then projections is when price is trending. So the projection is when you know that price is trending, and let's say that we're buying the dip, we're taking that retracement. So we've got our entry point somewhere here, for example, and we want to know where it's going to get to. So the first thing that I always do is if I'm buying the dip in an uptrend, I'm always going to look for a retest of the recent high. Now, it will depend on whether we've got a deep retracement or a small retracement. If you've got a small retracement, looking for that retest of the high is probably not worth it. But usually, if you've got a deeper retracement, then looking for that retest of the high, that should be the first target. That's the high probability trade. And on some of the stocks that we trade, certainly on the stocks that are in that top 50, they're going to provide some great opportunities. But what next? So projection is, for me, I'm going to look at the last move that happened, and I'm going to set, because again, we know that price is trending, and I'm going to look at the last move, the last thrusting move, and I'm going to measure that distance. So I'm going to take that measurement, the height of the thrust move, and I'm going to, let me tidy that up. Ooh. So we're in here. So I'm going to take the height of this point, point number 1, going to measure the end of that move, point number 2. So I'm going to measure that distance, and then I'm going to add it to the bottom of the next move. Now I've got to make a presumption here. I've got to presume that my entry point here is correct. And that's why we've put the trade on, because that's correct. Now, if you're entering on the break of the pullback, let's say it's a small pullback, it's the same thing. As price moves higher, then we'll know that, well, okay, that's probably the bottom of that movement. So I'm going to put my projection up from that point, and I'm going to measure and project that same distance. So if that's $10, I'm going to project $10 up from the start of the next move. Does that make sense? Everyone happy with that? So that's all a projection is. There's tools that can help us do that, but visually we can see that this happens. We can look at the last move and project it to help us forecast and predict even the next move. Let's go and take a look at it. So again, this is the other method that we use. Again, it's inside the profits training. So actually, let's use the same charts that we just used, WDC. So we've looked at targeting with a range. I can do the targets. Well, we've also got, although we've got a gap here, we've got a move and a breakout. Can everyone see that? We've got that gap down. So there's our trending move. We could also use that now if we want, because technically now it's broken out, it's the start of a trend. We could also use this move down here. We've got that thrust move, price is retraced, it breaks out and then trends. So we could also use that move. So it's just another example. If we look at the same chart in a different way with a different perspective, then we could say, okay, well, there's the trending move. Let's go and look at something like Microsoft, where we know that actually this has been trending for a long time. So what we can do is the same thing. We can look at the times that prices thrust up and down, up and down, up and down. We can look at the thrust moves, and we can help us to project the next move up or down. So we can, no, bear with me a second. I've pressed all the wrong buttons. Let me zoom in. There we go. So what we can do when we're projecting a move, we can take that distance, that height, and then we can project it upwards to see if it's going to do that same thing. So let's go and do that. So I can take the height. So there's the height of that move. Can everyone see that? So I've taken the height of that move. So that, again, I've got my grid set up a slightly different way to cut the move up. But all I'm going to do is I'm going to now project that from the start of the next move. Now, obviously, we're doing this with a little bit of hindsight. But what we can see is, in this case, we project the last move, that move there, and we've projected it upwards to give us a forecast of what could happen next. And this is what we call a projection or a measured move. In this case, it's followed through a little bit more. So now, because that is the most recent price action, I can take that move. I've just adjusted, I've measured that move. And I'm going to, and for the moment, a little bit sideways movement right now, but there's the bottom of the move for the moment. So I can project the same move upwards from that location. So a little bit of an adjustment. So what I'm saying here is, because price has put in a deeper retracement, there's that retest of the high that we were looking for. So on this case, what I would do is, because that 100% projection, because we've got this deeper retracements, is taking me to the retest of the high, I can add in a second target to say that, you know, if it goes past the highs, then I'll get a second target. So let me just add that on actually, so you can see that and how it works. So all I've got is a Fibonacci projection tool, and I'm going to add in, another one. Let me just scrunch the chart up. I've already got a different target on, but never mind. Oops, daisy, my drawing tool's just crashed. Bear with me a second. So what we have is we've got it projected up, that first green line, and this line up here, this is, there we go. So we've measured that move there. We've projected it from the low of the retracements, and there's the retest of the high. So there's that first target that I said that we were possibly aiming for. So then what I've also done, you just saw me add in, well, if that's 100% of the previous move, then this is 200%. So that's 2 times that move. And that gives me a second target. So if price was to kind of follow through and make new highs, then I can start thinking about a second target. Or what you could do, again, you can know all of this before you put the trade on, or in real time, you can just drag that grid up. It's going to give you a similar projection, and there we go. So put it on the high of the move. So we've got patterns and targets 2 ways. And just drawing my other thing out the way. So there's projections. So if price is trending, we can use projections quite nicely. And where's my, there we go. So, and then we've got mechanical. So I don't really need to look at the chart for this one. Mechanical is like an arbitrary, I'm not gonna type it out. It's like an arbitrary targets. That was the word I was looking for. Arbitrary targets. But it's going to be based on price. So for me, a mechanical target would be like, if you don't know how to recognize a pattern, if you don't know how to recognize a trend, if you don't know where to take the start points and the end points for either of those two things, what if you just want to keep it mechanical? One of the things that I love doing is to look at Spelling. Averages. We can look at averages. And I can take an average. Let's just say that the average, the ATR, the average true range on, say, a 20 period setting, the last 20 days on average is $10. So I can look at a multiple of ATR as a measure of my targets, and that keeps it mechanical. And one good thing about using a mechanical target is it's all, especially with a shorter period length, you can use a tool like ATR, the average true range, comes as standard in pretty much every charting platform. And you can say, well, if the average range of movements over the last 20 days, 20 bars, 20 hours, 20 minutes, whatever it is, 20x is $10, then I can times that by 1 or 2 or 3. Now, I like 3. I like to times my ATR, my average range of movements, by 3. So if you've got an average range of $10, well, your target is going to be 30. Nice and simple. That's it. And what you're going to find is whichever method that you choose is a lot of the time, these, I'm just seeing if we can get ATR up, average true range. A lot of the time, these methodologies, they all line up. Oh, I've got my ATR line on a different sub thing. What's it? Let's just put it there. There we go. So we've got ATR. So ATR here is, we can see that the average daily range on Microsoft. In fact, let's go back to WDC, because we've got a trade on this one. The average range of movements is $1. It's about $1.70. So the average range of movement, let's just call it $2, just because Phil's mental arithmetic is shite. And let's just say that it's $2. It's not far away. But let's just say that we want to use an average range of movements, and because the volatility has been small, because it's been in a range, if we want to work out a target, we've looked at the range as a target, we've looked at the trend as a target, you're going to get the same thing there. But we can also use, let's just say $2. So if the average range of movement is $2, approximately, it's not far away, but just for simplicity, we're going to times that by 3. And that's going to give me $6. So I can project that down from my entry, which is about 38. And guess what I'm going to get? So it's going to be 38 minus 6 is going to give me 32. So we're not a million miles away. So that's my kind of halfway point there. And then we can start to do, all right, target 1 is going to be $6. Target 2 is going to be $12. So I can now double that. So times 6 will give me $12. And then what we can project that down. So what we end up with is something very similar to the other two methods. Slightly discretionary, look at the range. You've got to be able to recognize the range. You can look at a projection. Oh, you've got to recognize the projection. Or you can just go, you know what? The numbers say that the average range of movement is about $2. So if I just multiply it by 3 or 5 or 6, you can use any multiple that you want. I use multiples of 3. So 3, 6, 9. So all you need to do is just project that down from your entry. So in this case, it's about $6. And from my entry, well, guess what? It's about $6. I'm looking for a move down towards $30. Now, with the other methods, I'm not far away. So what you're going to find is no matter which method of targeting that you choose, whether you have a pattern target, you're projecting, or you're using a mechanical with an ATR, so patterns are going to be range and projections are going to be trend. Whichever one that you choose, you'll find that they all generally overlap. You're going to get approximately the same targets no matter which one you use. And there's no perfect solution. And I think if you can let go of the next kind of preempting the next question is, well, which is the best one? There's no such thing. I use all three of these. I'll use a pattern. I'll use a projection. I'll be mechanical. It's a preference. Now, when I'm back testing the strategies that we were talking about earlier, I'm using mechanical because it's going to because I'm going back over 20 years of data, that means that I don't have to look at the charts. I can just look at what the number tells me is price volatility at that moment. So when I'm factoring targets 20 years ago, I don't need to scroll back and manually look at a pattern or a projection. It's going to be a mechanical, oh, the average range of movement was this, therefore I'm looking for that as a target. So from a testing point of view, there's no ifs, buts, or maybes. That's why it's mechanical, hence the name. So no matter which one that you choose, whichever is your preference, you're going to find that they all overlap. They're all approximately the same thing. And there's production line trading from a targeting viewpoint. You've got patterns 3 different ways: patterns, projections, and mechanical. Ranges, measured move from a projected trend, and mechanical using an average range of movements. I've used this pretty much all my career. ATR, average days move, average weeks move, average range of movements over, it depends on the time frame. It's always going to be a multiple of the price, because price is king. If price is really volatile, you're going to have a big target. If price is not so volatile, as we just saw on that WDC chart, you're going to have a smaller target. So it's going to be expanding and contracting relative to what price is doing. So if you're looking for a nice simple solution, go for the mechanical, go for an average range of movements. If you want to look at patterns and projections, nothing wrong with discretion. They're all going to give you approximately the same thing. So don't worry about which one's best. Just pick your preference, pick your poison, as it were. So that's where we're at. Targets 3 different ways. My name's Phil Newton. You've been fantastic. Thank you very much for your time. Thank you very much for your attention. The replay will be up in the members area, as I mentioned earlier. It will be up, available in the next hour. So if you're in Slack, I'll post it in there. It'll be available to rewatch in the next sort of half hour, 20 minutes or so. And then it'll be available in the members area for the rest of eternity. Thank you for your time. Thank you for your attention. I'll see you all next week. If you've got any questions, comments, or observations, by all means, send me a message on Slack or send me an email, whatever your preference is. But once again, thank you for your time. Thank you for your attention. And I'll see you all at the same time, at the same place next week. Bye for now.